Of the 5 decisions that every investor must make, perhaps the most important in the long run is going to be asset allocation, which can probably be defined as what your mix of cash, stocks, and bonds are going to be. There is a very famous chart that goes back to 1986 and redone in 1991 that basically says that asset allocation will account for roughly 91% of the determination of the success in your portfolio. This chart is very famous, it is widely cited, and last Wednesday, Roger Ibbotson, who is perhaps the greatest asset allocation expert in the world, said it's wrong. Okay, he says that that overestimates the importance of asset allocation. And if you are interested in why he thinks that the number might be closer to 50 or 60%, you can actually hear that program on Sunday because it re-airs. So anyway, this is the classic number. It's been used all the time. I've used it all the time. And Roger Ibbotson, he's one of the top guys in the country, certainly very famous for asset allocation. He says that it's wrong. But anyway, nobody I think that I know of that has credentials is saying that it's less important than, say, 50% in determining your long-term success in your portfolio. What you're obviously going to have to do when you decide on your own asset allocation is you have to balance the risks and you have to balance the benefits, and then you have to look at your own situation, because even people with identical portfolios one might be very appropriately balanced and one might be very inappropriately balanced depending on what their long and short-term goals are. I'd like to talk about some of the mistakes because this is what I see all the time. Let me tell you a big one is sometimes people have some fixed income like Social Security or a pension. So let's assume for discussion's sake that you have a pension and Social Security of $80,000 a year. Maybe a $50,000 pension and a $30,000 Social Security. And let's just say that you're kind of conservative and you say, well, for my portfolio, I would like to be 50% stocks and 50% bonds. Does that all sound pretty reasonable? Kind of balanced, right? Well, think about it. You have an $80,000 per year guaranteed income for the rest of your, and if you're married, let's assume for the rest of your spouse's life. Is that not like a little bit like fixed income? In fact, if you have $80,000 per year, and what are we getting on our CDs these days? 1%, 2%, let's even say 2%. Well, in order to get $80,000, you would actually need $4 million. If you had $4 million in CDs that were paying 2%, you'd have your $80,000. So there's one way to look at it is if you have a pension and Social Security, that's kind of like a fixed income. So even if you were 100% stocks with your million, in a way that's like having a 20% stock, 80% fixed income portfolio. Now I don't expect that you're going to make radical changes like that, but what I do want to open people's mind to is that let's say that these folks have identical portfolios and you have a big pension and you don't. I'm going to recommend a significantly different asset allocation because the person with the pension has already accounted for some of the fixed income. And since in the long run, having money in the market is always going to do better, then if we can cover our short-term fixed fixed costs with guaranteed income, then we're going to have a different portfolio, or at least we should have a different portfolio than somebody that needs the money for immediate income. Again, people don't switch to going from 50-50 to 100%, but I guess my point is people with pensions and Social Securities should take that into consideration when they are doing their asset allocation and diversification. Another one, a lot of times people base their asset allocation decision purely based on their age, and they don't take other factors into account. So most of my clients, by the way, are not great spenders. And many of them have a lot of money relative to their spending needs. So let's say you had $2 million as an example, and you're still spending $5,000 a month. Let's even say you're 75 or 80 years old. One way to think of it is, well, geez, I'm 75 or 80 years old. I want to be very conservative because I'm getting older and I don't have a lot of time for the market to go up and down. So I'm going to have most of my money in fixed income and bonds. Well, another way to look at it is, gee, you're only spending $5,000 a month. Social Security is covering half of that. You know, you could have even just a relatively small percentage of your portfolio in fixed income cover all your costs, and then maybe some of the other money should be invested not like a 75 or an 80-year-old, but like a 40 or 50-year-old, because ultimately that money is likely to go to your children. Very common mistake of people who are being too conservative, and it's costing their family significant money. And a lot of times I like to actually think of what the use of the money is for, and if it's ultimately for children, and if it's ultimately not for the children's Ferrari, but for the children's retirement, and the kids are 40, then having a lot of money in bonds and fixed income, particularly at today's rates, probably doesn't make a lot of sense. Very, very common mistake that we see. So what we like to do is to kind of take a look at the entire picture. I alluded earlier this morning that you don't want to go to a doctor and say, I have a problem with my right arm, look at my right arm, but don't look at anything else. You know, that it makes a lot more sense to go to a doctor and say, well, here's the whole picture. You know, I have this problem with my foot, and this problem with my arm, and this problem with my neck, or whatever it is. And there might be a more integrated, more holistic conclusion. I think that it is the same thing in money. And factors like Roth IRA conversion, Social Security, tax planning, estate planning, all tie into the issue of investing. I'd alluded earlier that I'm going to invest money much differently if I plan to spend it a year or two from now, in which case it's mainly going to be cash and maturing CDs, etc., than I am for money that will ultimately end up going to grandchildren, which might be invested 100% in the stock market. So there's different purposes, different needs, and the way I like to start is by doing an inventory of a client's entire assets. So one of the things that and I'll explain the way that I work, the money manager I work with, is we actually prepare a full balance sheet. So we know all your assets, whatever they might be. The other thing that's really important is what your cash flow is like. You know, how much money do you need when? You know, if you have an $80,000 income from Social Security and a pension, well, you should invest your money much, much differently than if you didn't have any Social Security or pension. So the other thing that we like to do in addition to a balance sheet is a cash flow statement. And that way, if you have a cash flow statement, you know what's coming in, you know what's going out, you know how much money you need from your portfolio, and you need when you need it, then you can do a much better job managing money. So one very common mistake. Let's say that I say, so Dale, tell me about your asset allocation. Dale says, well, I'm straight down the middle. I have 50% stocks and 50% bonds, and that's what I believe in because I'm a well-balanced guy. And that might be a reasonable asset allocation for his entire portfolio. This is something that I would prefer that he do. Well, Dale, how much money are you going to need in the next 2 years? Well, gee, Jim, I get, $25,000 or $30,000 for Social Security, but I'm spending about $75,000, so I'm going to need, let's say, another $40,000, $45,000 for my portfolio. Well, that money that he's going to need in the next 2 years, we shouldn't have that in a very aggressive stock market. That should be mainly cash, maturing CDs. Well, what about the money that he's going to need in years maybe 3 to 6? Well, we still want to be pretty conservative with that money because he needs it pretty quickly. What about years, say, 7 to 10? Well, there we can be more aggressive because if the market goes down, he has other money that's set aside that he can spend, and in 7 years, hopefully the market will go back up. And what about maybe years 10 and beyond? And for some of you, now we're even talking about estate planning. So it might be appropriate for you to literally have 5 different portfolios. And very few people do that. It's a lot more work for the money manager. But I'll tell you one of the problems that people had in 2008. They saw their portfolio go way down and they got scared. And a lot of them bailed and they punted and they switched to more fixed income. And then when the market went back up, they missed the return, and they will forever have less money. If they were set up like I'm recommending, they would have said, well, geez, the money that I'm going to need for the next 3 or 4 years is already pretty much guaranteed. So all I have to do is just wait it out, and I'll be fine. So there is not only an investment advantage, but there's a psychological advantage of having different stacks of money for different purposes. The money manager partner that I use, his name is PJ Denuzzo. He calls it the Denuzzo stack analysis. Where he's going to have a layer of cash and CDs and then a layer of still very conservative, but maybe slightly more money in stocks, etc. And then the longer your time horizon, the higher the percentage of stocks. Now, is it more work for the money manager, or if you're doing it yourself, to literally have 5 different portfolios? Absolutely. And sometimes you're going to determine the portfolio based on which type of asset it is. So for example, let's assume, to simplify, that you have 3 types of assets. After-tax dollars, money that you've already paid the tax on, IRA dollars, money that you have not, and Roth IRA dollars. In a different workshop, I talk about which assets to spend first. And I say, first spend your after-tax dollars, then spend your IRA dollars, and then spend your Roth dollars. Well, if that's the case, then do I want to have CDs and things that are paying, or even just cash, in my Roth? No. My Roth, I might want 100% in equities. And my money that I'm going to need in the next 2 years, I might want all cash and CDs. And I think a lot of people don't think like that, but I think it is a much safer way to think, particularly if you believe that we have volatile times coming ahead, which I do. So I think that this stack analysis is very valuable, again, whether you have a money manager or whether you are a do-it-yourselfer.